This is Przemysław Radomski, CFA, talking to you on November 4th. And in today's video, I'm going to tell you a bit about yesterday's strength in mining stocks and what it implies for the gold market for the following days and weeks. In short, it doesn't imply much, even though it seems like a no-brainer, a bullish no-brainer at the first sight. Well, it's not, and that's because of the context. At first sight, seeing strength in mining stocks, well, they did move higher, more so on a relative basis than GLD, which seems bullish. And indeed, it is bullish at face value, but as always, with all techniques, it's important to check if a given technique worked on a specific market, especially under similar circumstances. And the important thing right now is that the situation is similar to something from the past. Now, if you consider what happened recently, I mean the October rally and its size, and then the decline that followed, it gets obvious that there was only one event from the recent past that's similar, and that's the May and April rally, and then the May and June decline. The similarity is also confirmed by volume. The final top formed on significant volume, and the same happened in the second half of October. That was the top. Okay, so what happened recently was also in tune with what happened previously. We had some significant declines on relatively strong volume, okay, the more visible ones. Now the chart is getting cluttered. And the key thing is that we saw this small $1 counter trend rally right before the decline accelerated. And, well, that's exactly what we saw. From the intraday bottom to the intraday top, that was about $1 rally, very similar to what we saw in the first half of June. And since the history tends to rhyme, what we see on the charts now looks to be actually bearish and not bullish. So normally, if we just look at mining stocks performance at their face value, then yeah, they were strong relative to gold, but it happened after they have been weak for a few days. So this might be viewed as the one swell that doesn't make a summer, and a correction in the decline in the ratio between miners and gold. So after a few days of outperformance, there was one day of strength, and now more days of underperformance and weakness in mining stocks might come, just as one would expect it to be the case with price movements, not necessarily on a relative basis. After all, prices and ratios don't move in a straight line up or down. They fluctuate, they move in trends. Besides, please know that the GLD ETF and gold remain below their declining resistance lines. The breakout above them was invalidated in a clear way, and the decline back below it was tiny so far. It's likely to be much bigger based on the size of the preceding breakout and the invalidation, the importance of the resistance line, its size, the importance of the tops that it was formed on, that created it, I mean. Therefore, it seems like the rally is just, the decline is just beginning. And what we saw right now was just a, dollar counter trend rally, similar to what we saw in early June, right before the biggest part of the decline. So what we're likely to see? The biggest part of the decline. Therefore, I don't view yesterday's performance in mining stocks as something bullish. In my view, the outlook for the precious metals sector remains bearish. Having said that, I would like to encourage you to subscribe to the premium version of my gold and silver trading alerts. And if you're not yet on our free mailing list, I strongly encourage you to sign up for it. You should see the link somewhere over here. And once you do, you'll get 7 days of premium access to my gold and silver trading alerts as a starting bonus. I strongly encourage you to sign up today. Also, subscribing to our YouTube channel would be a good idea. And also, please know that whatever I said was just my personal opinion and not an investment advice. Please read the disclaimer below the video. Thanks. Bye-bye.